You would have seen episode 56 where we broke down what we thought the market was going to be doing over the course of the year.
Sort of reflecting on the year past and
ones that won't do well. It's a good year to hold property, so I'm not rushing to sell anything.
After those 3 rate cuts and the government incentive of 5% deposits, Sydney large format retail grew at 11.6%. So that's one of the fastest growing subsectors anywhere in the economy. Fire under the property market. There's government incentives getting chucked out everywhere at the moment. New Zealand as well, because dollar for dollar, it's a lot better over there. Treat ourselves for a day.
Oh, well,
have lunch here.
Nor don't let the likes of me come to places like this. So, g'day, how you going? It's Phil Tarrant here, co-host of Inside Commercial Property Recording for our final episode of 2025, the Royal Motor Yacht Club in Point Piper in Sydney, joined by Scott O'Neill, founder, managing director of Rethink Investing. Scott, how you going? Good to see you, mate.
G'day, Phil. Yeah, good to see you, mate.
This is a nice way to round out the year here.
Yeah, it's been a busy year.
Yeah.
Thought we'd treat ourselves for a day.
Oh, well,
have lunch here.
Nor don't let the likes of me come to places like this. So, but here we are anyway, and what a 2025 it has been. We kicked off the year, and you would have seen episode 56 where we broke down what we thought the market was going to be doing over the course of the year. So this is when we hold ourselves accountable, like all investors do, to actually work out whether or not we picked it, got it right, or whether he did at least. I just, the guy that navigates these conversations, debrief on the year that's passed, setting ourselves up for 2026, and you'll see in a couple of weeks' time our 2026 prediction podcast. So have a look for that coming through wherever you tune into your podcast. But Scott, 2025, are you happy with the year just passed?
Yeah, it's been good. So we've had 3 rate cuts. I think the first one was in February, then May, then August. So it went from 4.35 down to 3.6 currently, and it stayed there for the last few months. That's obviously put a fire under the property market. There's government incentives getting chucked out everywhere at the moment. Look, everyone's feeling pretty good about capital growth in the market. That brings volume, and short supply is just this big problem everywhere at the moment. Builders aren't getting enough supply out, and that's obviously sending the market, into a bit of a short supply scenario, and it's just going to keep happening by the look of it.
Yeah, it's interesting when you debrief on a year past, and because of the marvels of video editing, we can certainly paint ourselves in the right thing. We can probably find some grabs, and you'll see this over this particular podcast or video, wherever you're watching it, where we'll probably paint ourselves in the right light. And but I would say we got it largely right for 2025. The predictions that we made in episode 56, we called it. And I think a couple of things towards the back end of the year, which I didn't expect to happen, was the accelerated government incentives, which has really moved the needle the last couple of months or so. But largely up until that point in time, predictions were pretty spot on.
Yeah, we'll go through all the stats, and it's always very difficult to find the stats for commercial, but I think we've got them, and we'll go through how large format retail went, standard retail, office, industrial. The results are pretty fascinating. It's been pretty good overall because of the factors we've mentioned, but I'd like to say we've basically got most of it spot on, and that's obviously going to be, I guess, confidence for people listening to our next podcast, because we're going to go through our 2026 predictions, and there'll be some surprising things in there, but we're just seeing a lot of action in the market, and it's I think we're going to really see some good numbers into 2026 as well.
So tell me about Rethink for 2025. You happy with how it's all panned out?
Rethink Investing did really good this year in terms of volume. So the previous year, we're averaging around 42, 44 commercial deals per month. It's around 52 this month. So over 600 deals in the market. And, that's a nearly 20% growth rate for us in terms of volume. But our average deal size has gone up as well. So, very good for business. Interestingly, the total supply of the market is down. So one of our predictions, which we'll go into, is the fact that thought there'd be more supply in the market into 2025 versus 2024. But we've seen as interest rates have dropped, owners have really they want to hold on to their properties. They're more inclined to see upside in delaying selling. And that means the transactions are just often getting missed by expectations from buyers versus sellers. So slightly down, but our volume's up. And I guess the value is the real big difference.
So one thing we've spoken about at length over 2025, and we're recording this episode just before the Christmas break, and you'll be tuning into this on the 2nd of January, so everyone probably still nursing a small hangover from New Year's, and I'll certainly be in that lot. But we've spoken at length around the nature of commercial transactions and the size of volume of commercial transactions, value commercial transactions. It's tough to get a good commercial asset now under $1 million. And I think that's really precipitated through this year. It's got harder and harder. If you go back even 2 years, you would have been finding a lot more of those deals. So to your deal size, a lot of that will be contingent to, is it just your client base sort of moving up a notch, or you just can't get into those assets anymore?
No, it's a great point. I thought it was just us in terms of like the average client, having a little bit more money, but it's actually a market thing. So one of our other predictions, there's a lot of new resi buyers agents coming into the commercial market. That's obviously happened, but they're not transacting. So I thought this would actually mean there'd be a lot more sort of lower value, less valuable deals getting done, probably lower quality as well. But it seems like that hasn't happened because the overall market is seeing more of the fund managers come back in. So they're starting to do a lot more transactions over the 10, 20, $50 million range. So that's brought the overall transaction volume, to nearly 60 billion across Australia, which is up from the previous year, about 10%. And we're basically seeing less sales, but higher value ones across the entire market, not just Rethink.
And for your client base then, are they happy to wait until they've got whether more cash or equity to move up a notch in terms of the value of the property that they're buying rather than chasing smaller, lower market deals?
Yeah, 100%. So remember our episode with Pat Casey, Rethink Wealth. So he's obviously doing tailored financial plans, and a lot of the advice that he's giving clients is obviously hold off if you don't have the budget, or even sell down resi assets. There's a lot of refinancing going on at the moment due to the fact there's 3 rate cuts. Banking has got extremely competitive. Some banks are even offering cashbacks. So there's a lot of competition in the banking sector, which means lending is pretty easy. I shouldn't use the word easy. It's easier than it was the previous year. And we're just seeing more people refinance their whole portfolio to go into one transaction. And that's sort of what I was personally doing when I bought. I didn't want to buy little, deals in between. I'd just kind of wait, even if it was a year or two, and then go all in to the best quality commercial asset I'd possibly own at that time. That meant my average deal got larger and larger the bigger my portfolio got. And I'd have a similar delay, like maybe every 18 months I'd buy. But because the total asset value of my portfolio was larger, meant the next deal was larger because I was using capital growth and obviously some business profits and stuff like that in between. So that's a good strategy I'd kind of recommend anyone as a default. This is not financial advice, but it worked for me just in terms of sometimes less is more,
Yeah, and it's a mindset shift, I think, for a lot of people. And maybe, we spoke about it episode 56 where, and obviously through the course of the year where the sort of proactive mentality of investors is really shaping. And we spoke about a proliferation of residential buyers agents moving into the commercial space, somewhere where you've operated for many, many years. There's a lot more commercial investors in the marketplace than what there was 12 months ago, and certainly 24 or 48 months ago from where we are right now. Do you think that trend's going to continue, though? Do you reckon we're pretty much at a saturation point with commercial investors?
There's some reports out there. The latest transaction volumes in commercial is 7,754 sales per annum. And that's back, there's a Ray White report saying all this. Out of that, if you look at what Rethink's done, we've done 619 deals in the last 12 months in that same period, which represents about 8% of the total commercial market for all price points as well. So it's an extremely small market when you think about it. Compare that to residential, where there's 550 odd thousand sales per annum. And if you look at the data, they're estimating buyers agents in residential look after about 2 to 5% of the total market share. So if you kind of reverse calculate that and look at if Rethink Investing held the same market share as we do in residential, which is impossible, by the way, but we'd be transacting 42,000 deals per year. So that shows like we've got an extreme amount of influence in this commercial market, especially in the lower price points. And to answer your question, why that's important is there's really nowhere we can kind of expand our volume without taking more of a market share where we're kind of dominating already. And there's a lot of buyers agents in the space, but they're just not transacting many. Like we find it so hard to even get an extra deal or two a month because, there's only a certain amount of deals of quality worth buying. So this year, 2025 has proven that, even with the extra competition, it's not having cut through. And I think it's good and bad. I would like to see more people get into the commercial market, but it is that small.
Yeah, and you put it in perspective, if Rethink's doing 8% of all commercial transaction, which is significant volume and significant market share, the challenge for Rethink is how do you grow that? Well, you need to find, more people choosing a buyer's agent to transact commercial deals, and most still don't use a buyer's agent, so there's certainly growth there. But, market share can be chipped away by other buyer's agents sort of moving into this space. But you're so far ahead with Rethink, I'd say it's probably quite tough for other buyer's agents to come into this market. We've spoken about it at length over 2025, just because of the significant dominance you have with the weight of your relationships with agents right across the nation, being able to secure deals from them. Yeah. How are you going to defend that market share, do you think, moving forward?
So, number one, we're very strict on yield. There's obviously competition out there, and the competition that will beat us, they will go sharper on yield. That's the easiest way. Just convince your buyer to pay more. There's many ways to justify a lower yield. It might be longer leases, better quality tenant, whatever it is. But you still got to kind of maintain a minimum yield. If you don't, you can just open yourself up and pay more, and you can access more deals through paying more because vendors will say yes. Our way of expansion, it's limited in terms of the buyer's agent space because you can't force a deal. We expanded into New Zealand for that reason, and New Zealand's been going much better than I thought. We're transacting, a couple of deals every week over there in a small market the size of Sydney in terms of population. But when you think about like the volume, in terms of the volume, we're much lower on that scale because the bigger deals are done by those larger fund management companies. So, but they don't transact many. So when we're doing like 50, 60 deals a month, very low volume world, but we can up our dollar value. So one of our strategies is we want to obviously keep attracting high net worth investors into our mix because we can get really good deals for them. The other one is where we're getting into the syndicate market. We've got our AFSL now, so there's an announcement coming soon on that. So that's a really good strategy because a lot of people don't want to own their whole commercial property. There's a lot of responsibility with, you having to deal with the tenants. You've got to negotiate leases to decimal points in terms of accuracy. Otherwise, you ruin your valuation. There's a lot you can get wrong in commercial if you don't know what you're doing. Sometimes you just want to offload the responsibility to a responsible manager, someone who's got track record, access to good deals. And you might only own 5% of the deal, but it's 5% of a large industrial site with a 10-year lease or shopping centre with 20 tenants. That's attractive for, especially those people who, just want to plug something away in their super fund or whatnot. So that'll be another area of growth for us. If we can maintain what we're doing on the buyer's agent front, I'll be a happy person.
So let's break that apart. Let's start with Resi. When we got together, we predicted sort of reasonable markets, particularly in Perth and Adelaide for 2025. And I've seen some recent data come out which is sort of giving a sense to ongoing growth in those markets, particularly Perth and Adelaide, despite Perth sort of being quite hot for a period of time. How would you wrap up 2025 when you look at resi markets? And, we need to look at the elephant in the room. A lot of people think that Rethink only does commercial property, but you're very active in the resi space. I know a lot of people using you in the resi space to augment or supplement their commercial buying. So let's wrap up 2025 from resi. Did it perform as you expected?
Largely, yes. We saw growth in nearly every market. There's some patchy areas such as Melbourne, which went down, but everything's kind of moving on the way up after those 3 rate cuts and the government incentive of 5% deposits. We all knew what that was going to do. And the last 3 months of 2025 have been really strong for most residential markets. Units have done better than a lot of the housing markets, which made sense because there was a bit of a lag growth effect or people choosing to invest in houses first. But remember that I'd like to not focus too much on units just because I'm an old school investor. I just like focusing on things that are shorter supplied, and you can always build more units. And it's probably going to be the one area long term where you're going to see more action in terms of supply. So it's probably had a good year, or has had a good year, but you'll see houses just over the long term do normally 2 to 3% better capital growth.
Yeah, and the unit market's interesting. There's a huge disparity between the values of units and houses, and most commentators will say that units are undervalued at the moment. But whether or not that's just the realignment of how units and houses are going to sort of perform differently moving forward, who knows? But we saw at the end of this year, 2025, significant and already APRA intervention in relation to high DTI lending. They've got concerns about the growth of investment lending. I think it was 40-odd% of all new loans were investors. I think 46% in Sydney or New South Wales, for example. So this has really been a trend at the back end of 2025, which we didn't really predict because when we got together earlier this year, we're still waiting for the federal election to be called. We still didn't know how that was going to land. Certainly a lot of promises in there from the government, which are now just hitting the reality of injecting into the market. So the last 3 months has been very different to what I would have expected it to be in 2025. But largely the markets that we spoke about, Brisbane, Melbourne, Perth, have all performed well. We spoke about Melbourne early on then, and that was really only when it was getting a huge amount of investor activity. What's your sort of wrap up for Melbourne for 25?
Melbourne overall 2.5%. So there's a lot of focus on Melbourne for its affordability. Sydney grew 4% and Perth at 7.1%. So number one was Brisbane, Perth 7.1 at number 2, Adelaide at 6.1 in number 3 place. It is growing a lot quicker. It's trending upwards. But the top 3 markets were those more affordable capital cities. And rightly so, there's good fundamentals in those markets. They're probably pricing higher in terms of the overall cycle they're on. But I think there's room to grow as well. So not very happy with how that turned out, and we helped many clients into those markets. So it's been a good year for residential.
Yeah, and I look forward to sort of getting together with you in a couple of weeks' time when we sort of pull apart what 2026 is going to look like, whether or not we're going to get that same performance in those markets and other markets. But Scott, we spoke about retail when we got together in January, and you spoke about big box retail. Let's go to that clip as well.
We'll put it on the line. I think retail is going to have the best year next year in terms of overall growth.
What sort of retail? Like, we're recording this in Sydney above the where you probably go shopping at Prada.
Definitely
fancy
not.
shirt you got on. That sort of stuff, or you think
probably not that? No, so I'm thinking
high
like
street suburban,
big box retail, supermarkets, like even you can chuck medical into that, neighbourhood shopping centres, freehold stuff, anything with a decent yield in a good area that's kind of mispriced. You're going to see that have a good year.
So how's performance on big box retail? You were pretty adamant back in January that it was going to be a good spot to be. Are you happy with performance?
Yeah, so big box retail grew overall at 8%. Neighbourhood shopping centres, 8.1%. So that was the number one growth sector in the economy. We had industrial down into the 7% overall. So everyone would have thought industrial was the top market. But we picked it in terms of the growth rate. It's pretty hard to find a lot of data out there in terms of the large format retail market. But there's certain areas where it grew even faster. So Sydney large format retail grew at 11.6%. So that's one of the fastest growing subsectors anywhere in the economy. I guess I predicted that just due to the fundamentals. I wasn't even thinking in the outside. There's just value in it because the average yield for large format retail was higher than what we're seeing in neighbourhood shopping centres, industrial. People flow towards yields in these markets. So that's where the demands come from. There's not enough building in that space happening. Even the businesses are running at pretty good margins, like in terms of the actual tenants in these businesses as well. So, it's a healthy market at the moment. And if there's a housing boom, which we need one for stock at least, that's just going to help people. There's more building materials getting sold. There's more white goods. There's more electronics. Like when people rent or go to new places, build new homes, they need to fill it with goods out of these large format retail centres. So I expect the growth to, if anything, increase over the next 12 months, but we'll go into that in a lot more detail in the next podcast for our 2026 predictions. But we picked it in terms of retail, number one, but you've got to be specific with retail. It's not just retail as a blanket comment because we're not talking about strip malls or individual shops. We're talking about neighbourhood shopping centres, which got the 8.1%. That's, your Woolworths with the Coles, all those kind of supermarket tenants and the smaller ones around it, as that are getting anchored by the big guys. And then large format number 2, industrial number 3, and office a lot further down the track.
And with industrial, you specifically spoke about sort of secondary industrial, so older sheds with good yields. So Scott, do you think you're going to get the same performance moving forward? Is that held up as you expected, the sort of older sheds, good yields?
Secondary industrial assets performed, the best out of the industrial asset class. And again, it's the same fundamentals. This might be a basic way of looking at it, but it's got a high yield. People want high yields so they can justify paying more with the current interest rates. We saw the prime industrial, that's your 5,000 square meter big sheds with, selling at sharper yields to international tenants. The demand didn't really increase in that space. So we didn't see the growth rates that one would expect. There's been rental growth, which is the slowest it's been since 2021. Rental growth across industrial nationwide at 7.6%, so still way above long-term trends. And that's the saving grace for industrial, the rental growth. That is slowing because there is more supply coming out of the ground in terms of the micro stock, your sub 100 square meter type stuff, sub 250 even, there's more of it coming. So you've got to be a bit careful in that space. The good news in that space is owner-occs are paying premiums, sometimes 20, 30% above investors in that space. So even if you've lost a tenant, you think you've lost value and there's another building complex getting built, maybe selling to an owner-occ is your answer in that space. So there's different markets within markets, but industrial, it's still got that long-term viability, like the internet, everything being bought and sold, logistics, cold storage facilities. They're so important to our economy. We've got a shortage of it in Australia. And build costs aren't getting cheaper. So as long as build costs remain high, it's pretty hard to replace this stuff at cost.
Yeah, you make a really good point there. And again, putting in perspective, you spoke about Rethink doing a significant amount of market share in relation to transaction. These are commercial properties being bought by investors, but there's still a lot of owner-occupier activity out there. It's still quite common practice, and recommendations from accountants is to buy your business premises in your super fund. And that's still taking place. And I don't know what percentage of transactions are actually owner-occupier orientated with commercial. However, it's a good backup plan in relation to if you do need to sell your stock, there's multiple people who will buy.
Yeah, and that's where industrial has its own advantage. You're probably not going to sell retail to owner-occupiers generally. Even office, it's a little bit more likely, but industrial right now, a lot of them just want to own their own place. And the reason is, this is what agents all over the country have told me, the owners or the potential tenants are scared of that 7.6% growth rate. Like, it's a lot of rental growth that could be slugged upon you. So how to mitigate the risk? Just own the property. You might pay a little bit more, but long-term that rent growth might become less significant compared to owning a mortgage, for example, especially when interest rates are dropping. Yeah. There is a case just to own your own place in industrial. And, that in a way that's probably contributed to slightly increasing vacancy rates across the country. There is a bit of, I guess there's less speculation there, but owners are strong and not in the other asset classes though.
And we spoke about specialty through the course of 2025, medical, etc. But when we got together in January, we spoke about service stations in particular. Yep. Let's go to that clip.
Ones that won't do well, I think long-term service stations are just on a slow decline. They might be in good areas and that, but we all know the environmental, rehab you need to do to the sites. Just the funding is a bit difficult. Like, I like the cheaper ones. If you were going into that asset class, like, just don't buy a $6, $7, $8 million one because you may as well put your money somewhere else. But cheaper ones can be good deals because they could have 15-year leases to mobile or something, or, BP. Nothing wrong with that.
So the call back then, Scott, was service station investments maybe on the wane, environmental concerns are stacking up, maybe not a good long-term investment. Do you stand by that?
Yeah, look, so I've recently changed tact in terms of where the value is for these things, because long-term fuel stations represent, potential issues. But in the last 12 months, we've seen EV cars and whatnot. There's just change out of the US how it's viewed in terms of the take-up volume, and fossil fuel vehicles and that they're looking to, they're not going anywhere, let's face it. But the problem with service stations in 2023, 2024, and even early 2025 was they were priced too sharp versus other asset classes. Like, I was seeing these deals that didn't look special selling at 4.5%, 5% yields. When you can go buy a shopping centre with Coles in it in the same suburb at 6%. It didn't make any sense to me. And the market's agreed, and now the yields have increased significantly in the last 12 months. Like, we've actually done a few deals with clients in the service station range, like at 6.5 yield to a 10-year lease to mobile or, Ampol, things like that. They are repositioning themselves to be convenience centres as well. And a lot of them will obviously take up the EV charging stations and stuff like that when it's relevant, when it's economically viable. But look, a lot of them in good locations still hold value. But as a general rule, you just don't blindly buy fuel stations because you've got to, number one, get it at the right price, and number two, what happens in 25 years' time.
So wrapping up specific markets and asset classes, what didn't happen that you expected to happen?
Well, I thought there'd be more volume in the market. So just due to owners expecting more money every time the rates drop. Like, this is massive in New Zealand, by the way. So when we started Rethink Investing over in New Zealand, the average commercial rate was about 9.5%. That's for your mortgage. Now you're under 6%. So there's been a huge decrease in rates, and every time, even if we're halfway through a deal and the owner gets a rate cut notice over there, they're like, oh, I want more money, or I'm going to be less negotiable on the building and pest items. Like, the goalposts are changing there, and that has happened in Australia as well. Owners are just delaying selling. So we talk to a lot of agents. They are struggling for volume out there, and that's been a long-term trend now for the last few years. So I thought things would loosen up. Will it happen in 2026? Based on what we're seeing, probably not. Owners just don't have anywhere better to put their money. That's kind of what's coming.
And sort of connected with that, and we look back at 2025, supply and demand with all real estate transactions. I think the demand continues to increase around commercial assets, particularly at the sort of value where you buy. You've got a greater heightened focus from investors to create wealth.
Yep.
Through commercial, pivot away from resi, faster into commercial properties, which has put a lot of pressure on the demand side of things. But on the supply side, are development deals stacking up? We spoke about it in episode 56, some challenges and concerns with rising costs, access to trades, everything like that. So what's the washout then for you, Scott, for 2025 on development? Is it still a good time to be doing those type of projects?
I'm finding a lot of developers are holding off at the moment. So where they're the most active is in the smaller industrial space, because you can sell it. In Brisbane, for example, I'm seeing deals transact at $6,000 a square metre. If your build costs are $2,500, and you've got to buy the land on top of that, you can squeeze margins out. But a lot of existing stock can be bought at $3,500 to $4,000 a square metre. Larger stock even cheaper. So, to answer your question, it is tough to make a return in that space, and a lot of people, if they've owned the land for a long time, of course, they can make things work. But that's not really happening in, say, the retail market or office, for example. Like, premium office can get out of the ground if it's kind of backed, and you predetermine your tenants and you're selling at the top end of town rate. But outside that, there's just not much volume in the commercial market, which is good for capital growth. This is one of the reasons retail is growing, or because the population has increased in Australia so much in recent years, and we haven't built the amount of shopping centres needed. So, it's still a relatively weak market in terms of leasing. Like, vacancy rates around 8-9% across the country on average, and that's pretty typical for retail. But yeah, it's, I guess, the businesses that have survived they're doing okay. And we're finding once, I guess, the confidence returns, maybe we'll take another rate cut or two, you'll see that leasing market pick up, because that's what's lacked in retail. But yeah, it's a mixed market. It's so many layers we can go into it. But industrial, they're building. Retail, they're not. Office, just the premium stuff, A grade.
Yeah, it's a lot of conversions of B grade office into resi, and a lot of that taking place right now. But the concerns are around approvals, and we see it within resi markets. I think approvals were down the last set of numbers that come out, which is counter-cyclical to what the government is attempting to do, but at a local, state and federal level. This is just putting more pressure on established commercial. If you can't make any money out of developing at the moment, well, you're going to park it somewhere. Greenfield site for industrials, it's still a big thing. You see it coming out of the ground all over the place.
Yeah, so especially up in southeast Queensland at the moment, they're kind of getting ahead of what their, I guess, guesses are with the population growth, because a lot of the time industrial goes first. So there's areas like north of Brisbane where supply is a lot more than it was a few years ago, but the population growth is coming as well. So greenfield sites are the cheapest way to build industrial, but also the highest risk as well. So it doesn't work for every developer, but yeah, there is stuff coming out of the ground for sure.
So the mindsets of investors is something that you probably can map and monitor and get a sense check at any point in time, or a pulse check at any point in time. Over 2025, considering where we set the year off, considering attitudes and mindsets to commercial investing. Have you noticed any particular trends over 2025 which the best investors are doing, not from a tactical level where they're buying, but more of a sort of mindset type of thing?
Yeah, so I caught up with a lot of clients in the last couple of weeks, and I guess the general theme is they all want to deploy cash into the market because obviously the interest rate scenario, the fact that they're losing confidence in the stock market because of potential overvaluations and stuff like that. So a lot of them have already deployed their capital. These are just the individuals I spoke to. So they're now desperate to get refinanced, like get access to more capital, and selling is a big thing. So the general theme is sell their least favorite residential property or two. This is just experienced investors I'm talking to in this comment. And then once they've got that, they want to go into an asset class they're not already in. So a lot of them, for example, one of the guys I was talking to bought a really large shopping centre, and now he's got FOMO that he's not in the industrial market, so he wants to go into that. And then the next person I spoke to had bought a couple of smaller industrial. They don't want smaller stuff anymore. They want to go all in on the cheapest, decent quality retail centre they can buy, whether it's large format or a neighbourhood shopping centre. Like, would recommend both to them at the right price point. But that's the thing. People want to diversify. I always mention New Zealand as well, because dollar for dollar, it's a lot better over there. I'm personally buying over there at the moment. I've got a property under contract there, so maybe that's a diversification play as well, because I've got a good exposure to, my two favourite ones, retail and industrial in Australia. I don't want to go into a tower or anything like that. But yeah, the next step is, I guess, industrial in New Zealand.
So this is buyers being a lot more strategic rather than just reactive and responsive, trying to jump on market opportunities. They actually doing portfolio construction rather than buying stuff because they like the look of it.
Which is huge. Like, we're getting all granular on like which asset class grew the most in 2025. Like, none of that's important long term because they all average out at similar rates. Like, even in the book we wrote like 2-3 years ago, like it showed that office grew a similar value to industrial, and they all have their cycles because a lot of the valuations are attached to build costs and demand. And demand kind of means you're going to supply the right amount to the market long term. Otherwise, the developers won't make things float. But the build costs for, it's still concrete in all these asset classes, still reinforced steel, and still labour costs go into it. So everything kind of gets kept within a band long term. And you just don't want to go all in one asset class because what if industrial has a shocker over the next 5 years because something out of, a new AI tech kind of blew it up? I don't know. But if you got some convenience retail in there, maybe some medical, then, you're not overexposed to any asset class. I'm the same with, why I'm going into New Zealand. I just like the idea of having a bit of money over there. I'll probably never bring it back to Australia. I'll just reinvest it over there. It's just another play, really.
And give me a sense for financing over 2025. We saw interest rate cuts, 3 of them, early part of the year, which, put some money in the back pockets of investors and maybe increase their cash position. But I think they're now behind us, the interest rate reductions. Have lenders been favourable to commercial purchases over 2025, or have they been a bit reluctant?
Yeah, they definitely have. And I'm going to get Son on to talk about the financing in a future episode too, because it's so important to actually shop around in that space. But commercial lending is getting easier. We're seeing LVRs go up on average across the board. Interest rates are a lot lower. That's the big thing, because especially if you're doing like a lease stock loan where you need 1.5% interest rate cover or something like that, you just need a lower interest rate to make servicing stack. So yields are higher across the board for commercial and your interest rate's lower. So it's a lot better than it was 12 months ago. Overall, it's chalk and cheese at the moment.
So irrespective of the asset class, whether it's industrial, retail, etc., did any particular market outperform your expectations in 2025, sort of not at the suburb level, but maybe at a regional level?
Probably the strength of neighbourhood shopping centres was the top one, because that technically topped at 8.1% in terms of...
The neighbourhood shopping centre being somewhere in a...
Yeah, so when you look at the data, it's kind of referred to regional shopping centres. So it doesn't mean it's always in a regional area. It's basically just a neighbourhood, like it could be an IGA and it's got 6 tenants around it, stuff like that. People love those like little all-in-one portfolios, as they call them, because it's diversified, many tenants. There's more management and there's a bit of elbow grease that has to go into maintaining it annually. But Yeah, it's comfortable for the average residential investor to consider because there's a bit of general knowledge about, because we shop at these places. Industrial can be kind of sometimes viewed as a little bit niche, or, you don't know how to value it as easy, but the yields have been pretty good. So that's flowed money towards that space. I thought large format retail was at 8% versus 8.1. It's basically the same. Probably office was worse than I thought. The first half of the year was pretty poor for office space. Like overall, it dropped about 2% across the country in terms of the square metre rates. There's been some rental growth that saved that, by the way. So, average rental growth was around sort of 3.5 for office. So it's still going up, but there's incentives and stuff like that can be washed into that. But the good thing about office is it seems like it's bottoming out. There is tightening vacancy rates in all premium office classes. Secondary, it's a no-go zone there. But freehold, smaller suburban type office, I'm really liking that at the moment, like a lot, because the yields are just so high. Because everyone's kind of washing the values of, or the perception that all office is bad just because the towers are, oversupplied. Doesn't mean, the local legal office or mortgage broking company or even a hybrid dentist type, medical office space is bad. Because people since COVID have moved to the suburbs. They hang around the suburbs more. They're working from home. Theme is still there, and that's kind of pushed long-term more people in the local areas, and that means those local businesses are doing a bit better than they used to pre-COVID.
So drill down to neighbourhood shopping centres for a moment, and you spoke about top line number of commercial deals, sort of sub 8,000 transactions over the course of a year, and the fact that Rethink is, servicing about 8% of those transactions. How hard is it to find really good deals in neighbourhood shopping centres? There mustn't be that many that would get transacted over the course of a year. So, to sit and talk about the return on it, it's your job to go and find those. And I would imagine you've got a whole bunch of clients sort of saying, that's what I want. Yeah. Do they come up, or can you find them?
Oh, it's a lot harder. Before we started talking about it maybe 3 years ago, every deal we did over 10 mil was a neighbourhood shopping centre. Yeah. It's half that now. A lot of the biggest stuff we do is just a big flat industrial site with a good lease. We're finding it is very difficult to find a good site under 10 mil these days. Doesn't mean they're not out there, but they get snapped up at sharp yields. And again, you've got to keep your yield valuation there. Otherwise, you're giving away 2 or 3 years of growth just because you want to get into a market. That doesn't make sense. But yeah, we're finding them. We get them monthly, maybe even weekly, but in terms of our volume, that's not much out there. But yeah, that's where you can go into large format retail. It might be a single or multi-tenant one, 2 big leases. I was talking to a client, we bought one up just north of Brisbane a couple of years ago at 6% yield. He had really good lease reviews in there. So basically it was a fixed CPI plus 3% on it. So he's had massive rental growth over the last few years, and his valuation's up about 40% in 2.5 years. He's looking to refinance that. That's a large format retail, super cheap auto type businesses, which on a business level, they've got great business margins. So that business ain't going anywhere for a while. So great tenant. We've been buying a lot of Bunnings, small Bunnings at the moment. We've put a few of those on socials. We've been getting Bunnings at high 5% yields, where the average is normally low 4%. So we're very selective what we buy, but if you can get the right yield, you need to drop about 10 mil on one of those. But yeah.
Say Bunnings, does it make you a bit concerned with that? Because small Bunnings normally are prelude to a bigger Bunnings. So they'll start smaller, wait for population growth. They're very strategic where they invest. Is it easy to sort of find replacement tenants once a small Bunnings becomes a big Bunnings? There's always someone ready to move in.
So good question. So there's a few ways to look at this. Number one, Bunnings generally pay way below market rate. So there's potentially upside in the order of 20, 30, 40% if they left and if you found another tenant. We look at catchment areas. So one of the Bunnings we were looking at had no other Bunnings within 160 kilometres near it. So the catchment area of this, it was a regional area, was probably about 200,000. The site, about 7,000 square metres of building area. We're looking at about 11.2 mil in value. So you can't build the thing for that money, plus the land on top of that. Would Bunnings build another one out there? Not unless they wanted to waste money, because they're going to have to build it themselves most likely or purpose fit it. And the site's just fine. So what will generally happen is they'll build another satellite Bunnings, but that could be, in this case, could be 100 kilometres away. We're okay with that risk. The other way to mitigate it is, what is the lease length? This tenant just signed a new 5-year lease. If it had 1 year left and there was no commitment and there was a DA in place for another Bunnings, it's a dead deal. But if we get 5 years and maybe they renew again, that's 10 years of Bunnings. The area is not growing at super fast rates, so the chances Bunnings kind of pop up again in there, it's quite low. So there's risk with every deal. That is pretty low risk in my opinion.
And we spoke about the two arms of Rethink in relation to finding the deals and the DD of the deal. And the two separate teams, and they're orientated differently, they're incentivized differently. So these deals come up, but your DD on opportunities like that is still strong. Has that changed at all? The way in which you interrogate a deal over 2025 versus what you've done prior?
Yeah, so always. So one of the biggest things we focus on is due diligence. So obviously we did a due diligence podcast a few episodes ago, and we're bringing all sorts of things like AI into it, like different due diligence checklists for each asset classes is something we're focusing on as well. And even like tenant dependent, like the Bunnings one, we go deep into like where the other Bunningses are, their catchment areas, what other Bunningses have done long-term in terms of like, are they leaving sites? Like we can see the patterns of behavior through 100 other examples. So, if you buy a gym, you want to do an analysis on all the gyms around that local area. We've got to deep dive into who the operator is. Like you can have a checklist, but you've got to dive a bit deeper. And we do a lot of that up front. The good thing is half of our due diligence is done before we even present the deal. Due diligence is really there just to kind of verify everything we know, plus give us more time to dig deeper. And we're trying to find problems. Like we don't want to find them, we do really, but it's about sort of just hopefully everything is as expected. And if not, we're so comfortable walking from the deal. It's not even a question. Let's go. We don't want the thing because it's going to cost the client money. It's going to cost us time. And our reputation is everything. If we do a bad deal, word gets out. It doesn't matter that we've done 6,000 deals. It's just there's one unhappy
You're
client.
as good as your last deal, right?
Yeah, and things go wrong. Like an example of something I've seen in the market is changes in market conditions. So if you bought a deal 3 years ago, like let's say it was the peak of the industrial vacancy tightness, and now it's a little bit looser, you're probably going to feel a longer vacancy in some areas. So it doesn't mean the deal's bad. It's just the current subsector of that market, that local area might have a few extra deals in terms of leasing opportunities for tenants. So they're going to shop around, and that means we're not going to get someone as quick. You got to get more creative in these cases. So it's a forever moving target. But they're the biggest changes I've seen long term, just when the leasing market fluctuates. Like it's a bit weaker for retail at the moment, but on the buying side, it's white hot. That could do a U-turn in 3 or 4 years. You just got to roll with it.
And a lot of our conversations over 2025 has been connected with where to buy and what to buy. But once you've acquired an asset, there's the management of the asset, which is an ongoing and very important part of investing, which often gets overlooked. Any changes, any trends that you've seen on the management side of things over 2025?
Yeah, great question. It's literally one of the toughest parts of commercial at the moment because we're finding so many managers out there. They just fluctuate in quality. We've recently started using other managers compared to a few that we used years ago because their quality and their service dropped. So like, again, I always want to bang on about this. Like if any of our listeners have got a property manager that's not doing a great job, please reach out because it doesn't mean they're all bad. Like you've got a lot of new entrants into the market that might not have the same volume and they're going to try their absolute heart out to get the job done properly for the client. Sometimes you got to do things yourself. Like an example, so a client of mine bought a shopping centre. It had 1,000 square metre vacancy on top of this shopping centre. And this individual went out and called every gym owner in Australia that he could, and he filled it. And he signed a 10-year lease, and it's created him about $4.5 million in valuation upside. We didn't include that in the price because the vacancy was almost deemed as, it's always going to be vacant because it's such a bad tendency to fill. Like there's no foot traffic up there. It's literally only good for a gym maybe because 1,000 square metres is huge. He's got a national brand in there. No, I don't know if a property manager would do that. Like that's the problem. You almost got to just do things yourself. Even with my own properties like where I've got obviously, a reputation and people know me in the industry, you'd think they'll go above and beyond. Like I don't think they'd go to that level. You still got to do things yourself.
Got to do the hard work yourself.
Yeah.
Yeah. A lot of people think you outsource that responsibility through a manager, but still, if you really want the upside that you think you should be receiving, you've got to do the work, and doing the work takes time, energy, and effort.
Yeah.
But you got to subscribe into that if you're an investor. So more generally, sort of any major lessons for you in 2025? And the big mantra of this idea of I didn't like the lesson, but it was a good lesson. Where you just sort of, and you sit there and you go through, through the year and you go, this isn't good. I know this isn't working out, and you're not very happy about it, but you got to do something about it. Any of that for you in 2025?
Probably the management thing as well. So the more mature my portfolio gets, the less I care for it in a weird way. You'd be the same, Phil. You've got a lot of properties that, they become smaller, less relevant because of the total volume. And if you've got a noisy, like whether it's a residential house you're always doing maintenance on, or you've got a property that has repeated vacancies, the lesson is to cut your losses. A lot of people go, I want to wait till the market's higher. But if you're going to sell the deal at a higher price point and then buy back in a higher price point, not only are you paying more capital gains tax, you're paying a sales agent more and you're buying back into a more expensive market. Just cut your losses, sell. Dead deal's probably going to be dead for a long time. So don't be too proud to even sell at a loss if you're redeploying that fund into a better deal. If there's no reason to sell because you've got nowhere else to put the money, just hold on to it. It doesn't make sense to just turn it to cash. You still will make more money through even an average property, because it's leveraged and the market's going in the right direction. But other than that, it was kind of a really as expected year. Obviously we've gone through the predictions. We picked the exact 3 capital cities which would grow the most. Got the exact growth, in terms of the top 2 or 3 subsectors of the commercial market. It kind of played out as expected, and there weren't really any giant curveballs when you think about it. There was all sorts of things happening out of the US with trades, there's little. There's wars across the world, but none of that really transacted into a lack of confidence on the ground. So it's just been a balanced market, which is kind of why everyone's feeling fairly good.
Balanced market is a good market. And again, you've got to focus on those things you can control. You can get absorbed with all that's wrong with the world and that's wrong with the economy and all the reasons why you shouldn't be investing. But to your point around your own portfolio, it can be quite contagious when you've got unloved assets in your portfolio and sort of, fatigue and malaise sets in. That sort of changes your mindset towards it. And you go, I can't be bothered dealing with it and getting rid of it. And I think that's the biggest issue that a lot of investors face, right? Where you get to a point where maybe you end up where you've always wanted to be, but then you just go, well, it's not exactly right. So tinkering and interrogating and perpetually sort of being inquisitive about your portfolio is key. But if you're doing that by yourself, it can be quite tough. Did you see that from the best investors over 2025 with your client cohort?
Our clients for sure. I always bang on about you got to treat your portfolio as a business. It's something I've said from day one. And 99% of investors do not treat it like a business. They're running it at significant cash flow losses. They're happy to have a few bad years. Imagine you're the CEO of a company. You would not cop. Well, the shareholders wouldn't allow you to cop a bad quarter just because you're feeling lazy. You need to do things to fix it, whether it's cut costs or increase revenue somehow, or reduce budgets or increase budgets for marketing. Whatever it is, you've got to be super active, and that's what you've got to do for a portfolio. If you've got an asset that is underperforming, look to sell it. If you've got interest rates with certain banks that are higher, refinance, go to a different bank. Improve the cash flow any way you can, reduce debt. We're coming into a market, this is an upswinging market. By the end of 2026, if growth rates have been significant, we all know incomes aren't growing quick, in terms of wages. And obviously there's the AI threat in the world, which could increase unemployment long-term. Where's it going to leave us long-term? You just got to be careful with debt levels as well. You don't need to be maximizing your debt unless you're covering it safely through high cash flow assets. So if you, take a mortgage out at 5.5% and then you're buying a 6.5% yielding investment with a 10-year lease to an ASX listed company, that's probably a good bet. But if you're taking a negatively geared deal, let's say the average thing in Sydney where they're doing a 4% yielding random strip mall somewhere like that, and they've taken loan out on that at 5.5%. So that's negatively geared. That's a terrible deal, because what if things tighten up in a year or two's time and you're sitting on that? The banks will look at you. And again, this is about managing it like a business. I run my business fairly conservatively in terms of I keep the profit margins high. I'm not just maximizing ad spend just because I can. It's about managing the cash flows. So if revenue drops 30, 40%, it's fine. You need to have that kind of mentality with property as well. And we're in a growth run. It's been growing for the last 15 years odd. People forget that it doesn't always grow at this rate as well. And if you have that mindset that if it gets slower, I'm still fine, and these are the properties I've got to hold over the next kind of 5 years if it is slower, then you're probably going to do better than the majority of investors.
Yeah, it's well considered, and all investors need to have their appetite towards risk. I've got me personally, I'm very sort of a steer mindset. I'm always probably a lot like you, very conservative in that. I'm always thinking what happens if this happens, and there's always a backup plan around it. Yeah. So portfolio construction, particularly when it's commercial, should be built around that because, yes, you might have had a good performance in capital growth on resi portfolios, but most resi portfolios, most new resi portfolios I know of are quite negatively geared. So you only need a couple of things in the economy to change, which we may see over 2026. Yeah. Then might find yourself in significant issues.
And look, this is why APRA's recently stepped in. Like you mentioned before, investor lending's over 40% right now. A balanced market's probably under 30. So to your point, there's a lot of people pushing, let's just leverage up into residential as much as possible because the next year or two look good. That's again a risky strategy, and hence why the way you manage your portfolio is what many others should. You've got a lot of residential compared to myself, but your debt levels are lower as a result. You've got to manage your debt levels versus your income coming in. And again, if you've got to sell a couple to, flip the switch and buy a higher value asset, which gives you more income, that'll protect you in the darker times as well.
Yeah, and that's the sort of transitional part I am with my portfolio now. So leveraging a lot more up into commercial to satisfy a lot of those risk metrics and mechanisms and preparing for the decades ahead. But Scott, very detailed. I think we just really covered 2025, and there's 11 other episodes you can tune into from 2025. And I know right now, and you're probably listening to this early January, it's a great time to go back and binge. And there's a lot of relevance in everything that was said over 2025. Yes, we look at specifics and the immediacy of data coming through, but largely the fundamentals and the strategies that we discuss and adopt and interrogate inside commercial property is just as relevant. So go back and binge, and you can even go back to some of the earliest episodes of Inside Commercial Property where we look at the machinations of individual asset classes and how it all works. Largely very consistent. The numbers will be very different what it was sort of 5 years ago when we kicked off this podcast, and gives you some good sense to why commercial property may be the right asset class for you. But Scott, enjoy the chat, mate. So looking forward to a strong 2026, but privileged to spend 2025 with you, mate, every single month to have a yarn around property. And I'm very conscious and considerate of the reach that this podcast has, the influence that it does have with a lot of people making decisions around commercial. So hopefully we're helping people out.
Yeah, and again, thank you for a great 2025, mate. It feels like we've only been doing it a couple of years, but 5-6 years now. Time flies, but yeah, like you said, there are tens of thousands of people listening to this podcast, and so for the next one, I'm going to put a lot of work into looking into all the micro details of where the market's going. So we'll have our 2026 predictions, which if we go off what we did in the last year, hopefully we're that accurate again. But overall, I think we're in for a good period. But we've got to be measured how we take the growth out of that.
Nice one, and no doubt if you're tuning into this, you might have a chat with the crew over Rethink. You guys shut down over Chrissy and New Year's, or you can still find someone having answer if you want to kick into 2026 with proactivity. You're
not going to be buying deals around New Year's or that. There's, sales agents, especially in commercial, love taking time off that time of year. They are 5-day-a-week agents. They don't do the weekends like the resi guys. So, they would take holidays for sure. So, best thing is just to get your foot in the door. And this is why we're going to try to bring the next podcast, the February one, forward a couple of weeks, because a lot of people are going to be thinking about investing. So we want to get our predictions out. So before they take action, before they're back at work, they got a little bit more data to play with. And if we can get in into the market early 2026, it could be a good time for people.
There you go. Well, property investment favours action takers. So get stuck in. You can track down a team. Just Google Rethink Investing. It's probably the best way to find them. Scott, thanks for your time today. And thanks to everyone for tuning in. We'll see you again next time. Until then, bye-bye.